our money is not going to be worth nearly as much in 10 years as it would be in 2 and 5 years. That causes an effect on the mortgage market as a whole, with rates rising up to battle inflation. If you look at that number, it's a scary number, because if anything goes wrong, you get sick and you're off work for 2 weeks, a month, God forbid, whatever. What's the first thing that you're going to miss on? The largest payment, which is your mortgage. Make sure the payment, you understand that includes all of your property taxes, your homeowner's insurance, any HOA if you have it. Just make sure it's not a payment that they give you that's just your principal and interest but doesn't include everything else. My name is Mayer Dallal. I'm the managing director of MBANC, Mortgage Bank of California. We're a California-based company, mortgage lender, licensed in 26 states. I myself have been in the business over 20 years. Even though I'm a principal, I still function and originate and are very hands-on at the ground level.
Thank you for joining our channel today. My name is Michael. I am a Swiss consumer. We live in interesting market times. For the past 15 years already, mortgage rates were coming down. From the macroeconomic view, what do you think it's going to do to the mortgage market, to the secondary mortgage market? What's going to happen?
From a fundamental perspective, from when your 2-year bond yield and your 5-year bond yield are yielding higher than a 10-year, it's an inverted relationship. With historically, it's never been that way, because basically what the consumer sentiment is, our money is not going to be worth nearly as much in 10 years as it would be in 2 and 5 years. And that causes an effect on the mortgage market as a whole, with rates rising up to battle inflation. The challenge is, no matter how much you raise, I don't think you can offset the amount of money that was pumped into the market, and also the amount of liquidity that there is right now. With the lack of inventory that's available, we're at 30, 40, 50-year lows in terms of inventory. And that's why you're really, in my opinion, you're not going to see a major correction in the housing market, because there's not enough inventory to cause that type of effect.
Do you think our housing market is going to cool off, or it's just going to stay as hot as it has been for the past 2 years?
I think certain areas you're going to see a little bit of a correction. Other areas where it wasn't as hot, now we're going to cool off a little higher. But overall, like the hot markets like Florida, Arizona, where people are moving to, because of the limited inventory, I just feel that I don't see a major cool down in any markets like that. I personally just see more of certain pockets maybe getting affected by a little bit, but because of the lack of inventory, this market can sustain and has legs underneath it to be able to continue to grow. Maybe it's not 20% a year, maybe it's 7, 8%.
The typical consumer buys one house in their lifetime, gets one mortgage in their lifetime. Would you give advice to our consumers how to pick the right mortgage?
Mortgage is really all about affordability, in my opinion, right? And a game plan. You can't go into something saying, oh, I just want to get the lowest possible payment. Let me get an interest only and I'll figure it out later. Because at the end of the day, later is going to come. And when later meets now, you're going to have to know what you can do and what your strategy is. So really, affordability now, especially with the rates going higher, is essential. Typical homeowner doesn't have more than 5 to 10% max to put down. The market we're in that non-QM market where a lot of our buyers have 20, 30%. So that's a little different. But the average consumer, like you said, buys a house one time and they stay in it. On your regular conventional and FHA first-time loans, they can qualify you up to 45, 50% of your gross income. Now, if you look at that number, it's a scary number, because if anything goes wrong, you get sick and you're off work for 2 weeks, a month, God forbid, whatever. what's the first thing that you're going to miss on? The largest payment, which is your mortgage. So don't overextend yourself, even though you qualify. A bank can qualify you for anything because they're extending you to 50% of your gross income. Well, they're not taking into effect right now that groceries, gas, and everything is up 30, 40%. So when you're going to look at qualifying to buy a home, affordability is really, really important. And don't look at, oh, well, they approved me, so I guess I'm good to go. At the end of the day, you're responsible to make the payments and you're on the hook. So be very careful about that.
How much shall the person have in their savings account? How much shall the person have put aside for occasional repairs? And what is comfortable for people to usually pay?
We require 6 months minimum as a baseline. Now, most people don't have 6 months as your average first-time home buyer, but I wouldn't go below 3 months as a baseline mortgage payment. So if your payment's $2,000, I wouldn't go below $6,000 just to be safe, and keep that in a separate account. That's an account that you shouldn't have access to. You shouldn't touch. It should just be for, God forbid, something happens. It's super valuable to have that. You don't want to go down to the wire, put all your money in for down payment, closing costs. You have to pay for the move. You have to pay for the little things that come up, furniture, if you're going to get new furniture. Next thing you know, you're completely down to the wire with no money left, waiting for your next paycheck. And God forbid anything goes wrong. So I think 3 months at a minimum is a good cushion.
What kind of documents shall a person prepare ahead of contacting the mortgage broker?
So most traditional mortgages, your FHA, your regular conventional, require you to have 2 years tax returns, 2 years of W-2s, 1 month of pay stubs, 60 to 90 days worth of bank statements. So make sure you have all of that prepared. People are going to want to see that you have consistency in income. You have 2 years of income. So if you were W-2 and you went self-employed, you need to wait 2 years because you have to have 2 years of income. But if you were self-employed and you went W-2, as long as you have a stable job with a contract and 1 month's worth of pay stubs, you're able to qualify immediately. If you're self-employed, a lot more self-employed people have challenges because their tax returns don't necessarily reflect everything that they could make and what their true cash flow is. They're afforded the opportunity to write off things that the IRS allows them to, so their cash flow necessarily doesn't reflect. Where those opportunities can come to banks like us, where we utilize bank statements, we utilize 1099s, we utilize alternative means of qualifying an individual. But our loan to value won't go to 97. It'll be capped at 80, 85 maybe. We'll require a higher credit score because of the added risk that we're taking. But just have the main, if you're going for a regular conventional FHA, tax returns for 2 years, W-2s for 2 years, 1 month pay stubs, and 90 days worth of bank statements. And if you're going for alternative documentation, for sure, minimum 12 months worth of bank statements.
For people with low credit rating score, is it easier to obtain mortgage from smaller private organizations or larger banks?
I think right now in the market we're in, a lower credit score rating overall is going to be frowned upon, whereas when the rates were super low, affordability wasn't as big of a factor because the rates were so low. So people with lower credit score doesn't necessarily mean they're a bad credit risk but you have to just take that number as a number, because if you look at each individual, it's impossible to make a unilateral decision. So as a baseline from a bank, if you look at a score, let's just say it 620 or 600 or 580, most people are going to shy away from those or not lend to the max on that, because now affordability is a bigger factor. When money was much more free and much cheaper money, they were more apt to making loans to these types of, credit scores because it didn't really matter as much. Now it matters. So a poor credit rating is going to be harder for consumers to gain credit and gain access to credit.
A year or 2 years ago, a law has been passed that not all interest on the mortgage is tax deductible. Can you speak about it? What happened there? What's tax deductible right now? What's not for mortgage payments?
So from my understanding, your interest on your mortgage is tax deductible, and your property taxes are tax deductible as well. So, but the key is your interest. That's your biggest write-off you'll be able to get, and that's why a lot of people say go take a mortgage and get financing. And some lenders will tell the homeowner, change your dependence on your income, on your pay stubs, because now you have a mortgage deduction, so you can offset it rather than get it at the end. Get your money spread throughout the year. Personally, I don't suggest that because I think that's dangerous. Because if someone goes into a situation thinking one thing and then it becomes another, then they have a tax obligation. But from my understanding, all mortgage interest is tax deductible.
What mortgage would you recommend given the assumption that interest rates are rising?
It depends on the individual. If someone is a W-2 employee with a limited trajectory and how high their earnings potential could go, I would suggest only a fixed rate mortgage. And, I'm not that risk prone to take a risk like that. I feel someone who's got their income is stable and growing a little bit at a time, I wouldn't risk getting into an interest only just to qualify to buy a home and figuring it out later. The people that I feel who have potential to do that, if you are W-2, but you get big bonus income where your money comes at the end of the year, where you can afford to do those things and you feel you're going to continue to make more money, those are people I would say, hey, if you want to push a little bit, qualify for more, get an interest only. If you're self-employed, where you have cash flow that comes, that you understand, you're not going to pay your mortgage over 360 payments and pay it off. You know that you'll probably pay it off in 10 years. That's your plan. Or if someone wants an interest only, if they know they're not going to be in the house for more than 5 years, 6 years. It's a short-term thing. Majority of the first 10 years of a loan, for the most part, is interest, 7 years. So if you know you're going to be in less than threshold, you might as well take an interest only, lower your payments because you know you're going to be out of the house. Most importantly, a rate is just a number. It's affordability. What can you actually afford? Make sure the payment, you understand that includes all of your property taxes, your homeowner's insurance, any HOA if you have it. Just make sure it's not a payment that they give you that's just your principal and interest but doesn't include everything else. Affordability is key. And make sure, yes, it's an emotional decision. You fall in love with a home. And at the same time, though, you have to make sure financially it's a responsible decision. And when you decide to work with a lender, a broker, anyone, really feel comfortable with them and make sure they're going to take you through the process and they're going to guide you and be a leader for you and not just a rate and that's it. Unless you're savvy enough to navigate the whole thing yourself, then you can utilize someone just to push the paper. But if you really need the help and if you have some concerns or you want the guidance, find someone that you can relate to, that you can trust, and will work with you for you as an individual, not be a number in a queue.
Mayer, thank you very much.
Thank you so much. If you need anything else, it's my pleasure.